Test is now starting. All attendees are in listen-only mode.
Welcome, and thank you for joining us for today's webinar entitled A Look at Credit Risk Management in China's Banking Industry, brought to you by Kapronasia. My name is Paul Robinson. I'll be acting as the webinar moderator. Although Chinese banks have, in the past, not put a tremendous amount of focus on risk management, recent events and comments from regulators indicate that risk management will definitely become more of a focus going forward. In this, the second of a series of webinars on risk management in China, we'll look at credit risk management in Chinese banks in order to explain what it is, how and why it's different in China, and what will happen in the near future. In this informative 45-minute webinar, we'll also give you an in-depth look at the opportunities and challenges for banks, as well as the potential implications for vendors and vendor solution offerings. Now, I do need to inform you that today's session is being recorded and is run in listen-only mode. However, we really want to encourage feedback and questions from you throughout the webinar. To facilitate this discussion, we're going to use two features of the webinar software. The first is the attendee viewer, and that's made up of two parts. In this viewer window, you'll see the presentation, and I recommend maximizing that now so you can see it in full screen. The second is the control panel, where you can interact with us. This control panel can be opened and closed by clicking on the arrow button on the Grab tab. Now, in that control panel, you're welcome to submit questions and comments to our presenter. And as we always do, we'll be answering as many of these as possible throughout the presentation. We'll also be answering at the conclusion of the webinar too. Our presenter and host today is Fei Zhu. Fei is joining us from Kapronasia's office in Shanghai, whereas one of Asia's leading providers of independent research, custom consulting, and advisory services focusing on the financial industry and financial technology. They help clients understand and navigate the challenges they face in a region with a rapidly changing business, operational, and technological environment. So with all that said, let's get the discussion started. Fei, please go ahead.
Thank you for the intro, Paul, and thank you everyone for joining us today. During this webinar, we will discuss recent findings about credit risk in Chinese banks. In this report, the findings are mainly based on the secondary research, which includes internal knowledge, government, vendor, and financial institutions reports. The purpose of this report is to identify the current trend of credit risk in Chinese banks, define characteristics of credit risk, understand the Chinese credit risk regulation, and we will then last provide recommendations for banks to improve their credit risk management. In the first section, we'll have an overview of the credit risk in Chinese banks. In Chinese banks, credit risk is one of the most important risks, as Chinese banks are heavily reliant on profit from traditional interest rate spread between deposit and loans. From this figure, we can see that the loan balance is still growing steadily. Along with the increasing loan balance, the potential credit risk is still increasing. The second figure here you see shows the non-performing loan ratio in Chinese banks. Non-performing loan rates directly reflect the level of credit risk in the banks. Non-performing loans, or maybe you can say NPLs, are loans where the loan is not expected to be paid back in full. Generally, if a borrower delays repayment of principal and interest for more than 3 months, the loan will be considered a non-performing loan. A higher non-performing loan ratio indicates a higher risk to receive the loan repayment. In 2003, when major commercial banks tried to decrease the non-performing loan ratio, banks granted more loans to dilute the non-performing loan ratio because non-performing loan ratio equals to non-performing loan divided by the total loans. So the non-performing loans still exist, but the increased total amount of loans diluted the non-performing loan and made the non-performing loan ratio lower. And this year now, in 2013, the non-performing loan ratio is again on an upward trend, which indicates that the proportion of non-performing loan to total loans is increasing again. In China's banking sector, the non-performing loan ratio comes from a few sources. First one, 1.73% of the non-performing loan ratio is from Euro commercial banks. followed by 0.98% in the big five state-owned banks, 0.83% in city commercial banks, 0.77% in joint stock banks, and 0.59% in foreign banks. We can see that credit risk is increasing due to this non-performing loans. In China's banking sector, Euro commercial banks have the highest credit rate risk. Now let's move on to see the risk absorbing capability in China's banking sector. Here we have the provision coverage ratio. This one refers to the percentage of the loan that the bank has set aside as a provision against irrecoverable loans. The provision coverage ratio represents the bank's ability to cover these non-performing loans. In this figure, the provision coverage ratio is increasing, which implies that the risk absorbing capability is also improving in Chinese banks since 2007 and reached a relatively stable level between 2011 to 2013. Next one, capital adequacy ratio. This is another crucial indicator to measure the ratio of capital to risk-weighted assets. It's a measure of Tier 1 capital and total capital in banks in terms of meeting the risks, including credit risk, operational risk, and market risk. The capital adequacy ratio reflects the amount of loss that the bank is able to absorb. In the newer Basel Accord, Basel III, the required total adequacy ratio is 10.5%. In this figure, the capital adequacy ratio in Chinese banks increased rapidly from 2007 to 2008 and remains on a stable level of 12% to 13%, which is above the international standard. These indicators represented an improved and strong risk resilience in a stable credit risk environment. Although the balance of non-performing loan and non-performing loan ratios are higher than previous year, the current risk resilience is capable to control and manage the credit risk existing in Chinese banking sector. A strong credit risk management system is important in order to manage and reduce credit risk. Although the Chinese Banking Regulatory Committee, the CBRC, has strengthened the requirements on bank credit risk, the demands on credit risk management solution will increase dramatically. Based on research on the expenditure on credit risk management systems, all categories including storage, server, network, infrastructure software, application software, and application services are expected to increase every year in Chinese banks. In the second section, we will take a look at characteristics of credit risk existing in Chinese banks. Based on our findings, now we summarize the three main characteristics of credit risk. The first one here we see is concentrated credit risk in Chinese state-owned banks, largely a result of the major state-owned commercial banks having the largest market share in the banking sector compared to other joint stock banks, city and commercial banks. The concentrated credit risk in state-owned banks is an issue that needs focus. Although the market share of state-owned banks is shrinking every year, as we can see in this chart, they still dominate the market. The high market share will result in highly concentrated credit risk in state-owned banks when the obligor is encountering adverse operating condition or the industry is in a downturn. The increasing in non-performing loan ratio mainly reflect the increased non-performing loan in the state-owned banks because their large market share. So state-owned banks have to take the high credit risk because of because of their large market share. So state-owned banks have to take the risk, high credit risk because of their dominant standings. And we see here the second one, we see concentrated credit risk in certain industry is another issue in Chinese banking sector. Some banks have a very high loan balance in a single industry. For instance, Bank of Kunlun, one of the Chinese city commercial bank, has focused its loan business on oil trade. The loan balance for oil industry is more than 12.5% of the total loan balance, and more than 50% of customers are from oil industry. The credit risk will be high if the oil industry goes down. As we know that the Bank of Kunlun, their non-performing loan ratio increased from 0.3% to 1.8% in 2012. Next, characteristics of credit risk exist in the increasing large shadow banking system. Shadow banking refers to the financial intermediaries involved in facilitating the creation of credit but are not subject to regulatory oversight. It is also defined as financial intermediaries that conduct function of banking without access to central bank liquidity or public sector credit guarantees. The size of shadow banking system has increased to 22.9 trillion yuan. This is around 3.7 trillion US dollar, which represents 34% of the bank total loan balance and 44% of GDP in 2012 in China. There are two types of shadow banks. The first one is the off-balance sheet bank loan. The other one is the unregulated private financing activities, which includes underground banks, private credit, and pawn shops. The off-balance sheet credit risk mainly comes from wealth management products. The details on the off-balance asset are not disclosed to the wealth management product customers. The mismatching of fund maturity may lead to liquidity risk, and banks possibly fail to pay the funds back to customers. Shadow banks lend money to risky small and medium enterprises, and high credit risk may result in defaults on the credit agreement if the fund borrowers has difficulty to make required profit and defaults on the obligation. The shadow bank may fail to repay the fund back to the fund provider. Here comes the last characteristic. This one is related to loan investigation in Chinese banks. Chinese regulation requires banks to investigate loan borrowers before approving loans, during the loan period, and after lending a loan. Approving loans that don't necessarily meet banks' credit standard and not being strict on loan investigation happens in many Chinese banks. The violation contributes to what has resulted in an increase in the scale of unqualified lending to a total 24.57 billion yuan. Banks not only lend funds to the project or firms that do not meet the loan condition, but also not strictly check the purpose of use after actually lending the money. Obviously, the loose regulation on loan approval encourages the potential credit risk in Chinese banks. In the third section, we will look into three main credit risk regulations in China. To improve the credit risk management in Chinese commercial banks, CBRC issued the guidelines for the supervision of the internal rating system for credit risk of commercial banks in 2008. These guidelines require Chinese banks to establish an independent and internal credit rating department to identify and quantify the credit risk based on the debtor and debt risk to capture the possibility of default, exposure at default, and loss given default. The internal rating system for credit risk needs to then store the relevant information and keep the result independent and accurate. The internal rating system has caught the attention of some Chinese banks. Especially for those state-owned banks, they started to develop an internal rating system with cooperation from international institutions, and many have fully established an internally functioning system. The Industrial and Commercial Bank of China, ICBC, successfully realized customer rating, debt credit rating, possibility of default, and loss given default measurement, and non-retail credit rating. Also, Bank of China, China Construction Bank, Bank of Communication, and Agriculture Bank of China have implemented internal credit rating system. However, credit risk management is still not mature in Chinese banks because of the lack of advanced credit risk econometric model and techniques. In order to better regulate specialized loan, CBRC also released the second guideline, the guidelines on the measurement of regulatory capital of specialized loan of commercial banks. The specialized loans refers to project financing, object financing, and real estate which generates income. This guideline classifies regulatory rating standards for the specialized loans based on their financial standing, political and legislative environment, trading features, asset features, guarantee arrangement, and the organizer's strength. Guidelines for the measurement of regulatory capital for credit risk mitigation in commercial banks describes the requirement for each credit risk mitigation technique evaluation method, management process, corresponding information management system, and how to reflect the risk mitigation effect with risk mitigation tools. It does not only provide a diverse method to manage credit risk, but it also reduces the risk arising from varying value on the risk mitigation techniques themselves in Chinese banks. Okay, our last section of this webinar will provide recommendations for credit risk mitigation. On the credit rating system aspect, we recommend that both internal and external credit rating systems should be independent and not involved into any special interest relationships. Improving the internal credit rating system and adopting external credit rating as reference will help banks to obtain more accurate information on the obligor's credit risk level. Credit rating system also can be enhanced by increasing data collection. To enhance the internal credit rating system requires collecting data on loss given default and possibility of default, which will be helpful to improve the quality of credit risk quantification. The lack of data collection affects the internal credit rating application and development in Chinese banks. At the same time, banks have to conduct reviews on data quality to ensure the accuracy and comprehensiveness of business data. Quantified credit risk can help Chinese banks to improve their credit risk management. To implement advanced credit risk measurement models and internal rating systems, Chinese banks have to increase their expenditures on credit risk management to keep developing and introduce this mature and enhanced econometric model and techniques. Well, we have collateral management here as one of the main forms of credit risk mitigation. Collateral itself has risk involving operational, market, and legal risk. The valuation of collateral is important from the beginning of the contract to the end. However, the valuation of collateral can be affected by the market risk or its own property. Banks have to firstly ensure the eligibility of the collateral. In other words, the collateral must be liquid enough to be able to be converted into the required value if the counterparty defaults. While applying collateral to mitigate the credit risk, banks also have to consider other disadvantages related to collateral. Let's talk about the application of credit derivatives. The application of credit derivatives is still kind of new to China. Credit derivatives are various instruments and techniques designed to separate and transfer the credit risk of an asset from one counterparty to another. Chinese banks should slowly facilitate the application of credit derivatives. It can help banks to improve the credit risk management by transferring the credit risk away from the lender. By applying credit risk derivatives, banks can transfer credit risk without transferring asset away from the balance sheet. So banks can effectively control the credit risk exposure while expanding their business. Credit derivatives innovation can replace some of the traditional credit risk management and business model and improve comprehensive operating risk management by activating credit asset and strengthening asset liquidity. Stronger supervision of credit derivatives is also crucial to prevent credit derivative overdevelopment and risk proliferation. Finally, we have also mentioned here a good credit environment reduce general credit risk. Building a strong credit culture within a bank is helpful to eliminate the possibility of any improper employee actions on loan credit rating approvals. The culture should not be only limited to credit officers, auditors, and senior management. Along with the changing and complicated macroeconomic environment, only comprehensive risk management can help banks to build a solid foundation to mitigate credit risk. And hopefully our findings will assist Chinese banks to improve their credit risk management and technology vendor better position their offering to Chinese banks. And thank you for taking the time to attend the webinar today. Now I would like to hand it back to Paul, and Paul will address any questions that you may have.
Okay, thanks very much, Faye. Thanks for all that great information. All right, as I mentioned at the top of the webinar as well, we are taking your questions via the chat facilities or the question and answer facility in there. So if you've got your questions and you'd like to ask them of Faye, then please send them in while we go through these questions that have already come in here today. So Faye, the first question comes from Jackie, and it says, why is it necessary for banks to improve credit risk measurement in Chinese banks?
Well, I think it's important to improve credit risk measurement in all the banks. But as we know that People's Bank of China, the PBOC, just announced to liberalize the lending interest rate. It facilitates the financial reform. And because of this economic transformation in China, the target loan customer is slowly shifting from state-owned enterprises to small, medium, and micro enterprises. And those small, medium, and micro enterprises, they generally have higher credit risk. So to improve the credit risk measurement techniques is very important when Chinese banks want to shift their loan business to those small, medium enterprises.
Okay.
Yeah.
Thank you. Okay. Another question here. This one's from Helen, and it says, what is driving the increase in shadow banking in China?
I have to say that the shadow banking system in China is different from those Western developed countries, and it is also a complicated for China to have those shadow banking system. But one of the main drivers is the tight regulation on the formal credit system. The CBRC is requiring banks to decrease their existing loan exposure and strictly control and monitor newly approved loans. So many local government projects are not able to gather enough funds to finish their projects and cannot repay the loans because the CBRC's tight regulation. So they look to shadow banks where they can get more funds to finish their projects. And many informal financial intermediaries have appeared to satisfy this local government's demand.
Okay. Got a couple more here that are coming in while we're chatting. Next one's from Jackie. How How does shadow banking affect the regulated banking system?
Um, so, well, we know there are a lot of off-balance sheet wealth management products, and normal bank customers, they really like to purchase those wealth management products, and this will reflect on balance sheet as non-performing asset they if those wealth management products they encounter any problems or risks. But these products are guaranteed from bank or government, so they're unlikely to default directly. And shadow banking makes credit decision more complicated and not transparent, which potentially increase the difficulty for credit risk management in formal banks indirectly. I hope that answered the question.
Yep, that is perfect. Thank you very much. All right, another one here from Michael. I think this one's yeah, Michael's asking, what are the sources of credit risk in Chinese banks?
Well, yeah, we know that this year, um, the economic growth in China kind of slowed down. So currently, the credit risk just mainly comes from local government financing platform, real estate loans, small and micro enterprise loans, and also the off-balance sheet financing business. And Chinese banks have limited their lendings to local government, so trust products have become the main funding source for local government, and the expanding debt scale will increase the potential credit risk, especially in small and micro enterprises, which have potential higher credit risk, as we discussed before, from those small and micro enterprises.
Okay, again, we've got a couple more that are coming in here. We've got one that's where Kenneth, we'll just get to you here in a moment. We're just going to get through one more and then we'll get to your one, Kenneth, that's come in. This other one's come from VJ, and it says, do you think the credit risk will continue to increase in Chinese banks?
Well, I think under this economic environment, and China really trying to do the economic transformation recently, and those things brings a lot of uncertainty this year. And also, as we see that the non-performing loan ratio is actually increasing in the major banks in China, so we do really think it is possible that the credit risk will continually increase in Chinese banks.
Okay, good. Um, okay, Faye, this other one has just come in from Kenneth, and we're going to modify it a little bit for it's actually a combination of a couple of questions that have come in from various people. So, in your opinion, are there any Chinese banks or really banking segments that have shown some vulnerability or you think are at greater risk from the recent liquidity crunch? So is there anything you're able to provide there? So either Chinese banks or actually banking segments that you think might be important to talk about?
Well, maybe because CBRC or PBOC just liberalized the lending rate, interest rate. So I think this is a big move for Chinese banks to go uh, marketization, but I'm not too sure they will really used to this environment, and they probably face more challenges in the future, in the near future. And we see on the stock market that most banks, their stock price all decreased recently.
Okay.
Yeah.
Yes, it's funny how that works together. Okay, well that's good. So look, we've got through most of the questions. In the interest of trying to save some time here for everybody as well, we might end up just cutting this just a little bit short. We'll give you back the 15 minutes that we said were in there. Now, I notice there are a few more questions that are starting to come in, but look, don't worry about that. We've been answering them in the background, and if we didn't get to your question, or we haven't, or you send it in after the webinar's over, don't worry about that. We'll get back to you individually and take care of your questions. Of course, we love them when they come in during the webinars, and we'll take care of them, as I mentioned. Now, so as I mentioned during the session, today's discussion was based on Kapronasia's upcoming credit risk management report. This report offers a critical insight into credit risk in China's banking sector today and is available as part of Kapronasia's subscription service. Now, if you haven't already registered for this valuable service, we'll also be providing a link to do so in the email you'll shortly receive, thanking you for your attendance here today. In that email, there'll also be a link to the recording we've been making of today's presentation. So that way, if there's anything you've missed or you want to review some of the information that Faye was presenting here today as well, you can do so, and you can listen again at your own pace. And once again, Kapronasia appreciates your time today. Hopes you found the information informative and helpful. This concludes our webinar. Thank you very much for joining us.